Most people think Qatar is rich because of oil. That assumption is wrong. Qatar's oil reserves are modest. Its population is tiny. Its geography is harsh. Its history is short. Yet Qatar quietly became one of the richest states per capita in human history. With sovereign wealth rivaling superpowers and political leverage far beyond its size. So here's the mystery. How did a desert peninsula with no industrial base, no large population, and no early oil boom end up controlling a critical artery of the global economy? The answer is not resources. It's timing, monopoly logic, and strategic patience. And once you understand how Qatar actually got rich, you'll realize this wasn't luck. It was a blueprint. Before gas, before wealth, before global influence, Qatar was irrelevant. Till the mid-20th century, Qatar was a purling economy, politically weak, economically dependent, strategically overlooked. Pearls collapsed when Japan invented cultured pearls. British protection ended in 1971. Oil existed, but not at scale compared to Saudi Arabia or Iran. By every historical pattern, Qatar should have remained a minor Gulf state. Instead, it waited. That waiting is the key. In 1971, something massive was confirmed beneath Qatari waters. Not oil, natural gas. Specifically, the North Field, the largest non-associated natural gas field on Earth. Qatar shared it with Iran, where it's called South Pars. At the time, this discovery meant almost nothing. Why? Because natural gas was considered difficult to transport, hard to monetize, less strategic than oil. Gas was regional, oil was global. So Qatar did something unusual. It didn't rush. It's cause and effect why waiting was the smartest move. Here's the critical decision most people miss. Qatar delayed extraction. While others pumped oil aggressively, Qatar studied LNG technology, shipping economics, long-term demand curves. The 1970s and 80s, liquefied natural gas was expensive and risky. But Qatar understood something structural. Oil powers transportation. Gas powers everything else. Electricity, heating, industry, fertilizer, future energy transitions. Gas was not a fuel. It was a platform. Engineering a monopoly, not a boom. In the 1990s, Qatar made its real move. Instead of exporting gas via pipelines, Limited and Geopolitics invested heavily in LNG. This mattered for three reasons. 1. LNG broke geography. Liquefied gas could be shipped anywhere. This turned Qatar from a regional supplier into a global one. LNG required massive capital. Few countries could afford LNG infrastructure. Qatar partnered selectively, keeping control while importing expertise. 3. LNG locked in long-term contracts. Qatar didn't sell spot gas. It sold 30-year contracts. Stable revenue, predictable demand, pricing power. While others chased price spikes, Qatar built permanence. Key figures quiet power, not loud leadership. Qatar's rise wasn't driven by charismatic populism. It was driven by technocratic continuity. The ruling Al Thani family made one priority clear. Control the resource. Control the timeline. Control the contracts. Qatar Petroleum, now Qatar Energy, remained state-owned. Foreign companies were partners, not owners. This prevented the classic resource curse. Qatar didn't outsource sovereignty. The breaking point when gas became geopolitical. For decades, gas was boring. Then the world changed. Climate policy turned against coal. Nuclear stalled. Renewables couldn't scale fast enough. Natural gas became the bridge fuel. Demand exploded. And suddenly, Qatar wasn't just rich. It was essential. The real breaking point came when energy security replaced energy price as the priority. Crises exposed dependency. And Qatar sat at the center. Why Qatar had leverage others didn't? When supply chains tightened, Qatar benefited because it controlled production. It controlled liquefaction, it controlled shipping, it controlled contracts. No transit countries. No choke points. No middlemen. This is what monopoly power actually looks like. Not total dominance, but structural indispensability. Unlike oil states that boomed and crashed, Qatar achieved something rare: stability. Gas contracts smoothed revenue. Sovereign wealth diversified globally. Population size kept per capita metrics extreme. Qatar didn't just get rich, it stayed rich. And that allowed it to influence diplomacy, invest globally, absorb shocks others couldn't. Failed fixes why others couldn't copy it. Many countries tried to replicate Qatar. Most failed? Why? Because Qatar's model required early patience, centralized control, political continuity, long-term thinking, no democratic pressure for short-term spending. Most states extracted too fast, privatized too early, spent too aggressively. Qatar didn't chase growth, it engineered position. History rewards those who control infrastructure, timing, bottlenecks. Venice controlled trade routes. Britain controlled shipping. America controlled finance. Qatar controls molecules. Energy transitions don't eliminate power structures. They rearrange them. The big illusion, it was just gas. It wasn't gas was the tool. The real strategy was delay, concentrate, lock in, diversify outward. This is how small players beat large ones. Not through force, through system design. 3 takeaways. 1. Resources don't create wealth. Control does. Qatar didn't sell gas. It sold access. 2. Timing beats speed. Those who wait strategically often dominate those who rush. 3. Energy is power, not just fuel. Whoever controls energy, controls options. As the world transitions again this time away from fossil fuels, the next Qatar is already being built somewhere else. The mistake is assuming power disappears when technology changes. It doesn't. It relocates. If you want deep historical breakdowns of how money, energy, and power really move beyond headlines and slogans, subscribe. Because the real empires aren't always loud. Sometimes they're patient.